honestly, probably the thing that we see new clients come to Plancorp the most about is like kind of that triggering event. It's usually taxes. Hey, I got hit by a huge tax bill last year, or even if it wasn't a huge tax bill, it was an unexpected tax situation. So taxes, no matter what type of equity comp you have, are going to be a factor. They're all forms of payment in some way, shape, or form, but they all act very differently. So that's where we're going to dive into first. Um, Maybe start with ESPP and kind of share some thoughts there.
Yeah, I mean, honestly, I think ESPP stock is like the most complicated in my mind for
Yeah.
a tax purpose, even more so than like ISOs that have AMT implications. There's just so many different moving parts to that. It'd be helpful to kind of get into it at a high level. Yeah.
Yeah. Yeah. The ESPP, employee stock purchase plan, for those listening. Basically, in my mind, I like to compare it to the Shrek analogy of it's like an onion. It's got layers. So there's an income component. There's a part that can be income or capital gain, and then there's a part that's either short term or long term capital gain. And you don't need to understand each of those to like the nth degree, but having a brief understanding of those is really important, especially because unlike things like RSUs where there's some tax withheld for you, ESPP when you sell, it's on you to pay that tax bill.
Also,
So whenever you sell something, you sell your ESPP shares, you just get the net proceeds. There's not any amount of that. Your payroll you get from your employer, 22%, whatever amount your payroll withholds. That doesn't happen with an ESPP sale. And so I got $10,000 from my ESPP. Well, great. How much of that is actually going to have to get sent off to the government for state, local, federal taxes? That's often overlooked because people expect it to just be done by their employer since it's through their employer.
well, especially if you have RSUs, which again, like the tax triggers, I think are important here too. So like, what creates a taxable event?
Yeah,
So
it's a
I'll
very
come
good
back to
point.
ESPP, but like with RSUs, what triggers tax on that is whenever they vest. That can be monthly, quarterly, annually, whatever that looks like. But when that happens, there's withholding, usually 22%, which can be a pain point in itself
Yep.
because if you're in a higher tax bracket, that may not be enough. But with ESPP stock, whenever you actually buy that stock, that's not a taxable event, which is why there's no withholding there.
Yep.
But then you turn around and sell it, and you've got these three or four different components of it, and like that's why nothing is withheld from that. And so that's a good example of needing to know, like, okay, what triggers the tax on this? Is there any sort of withholding or not? Do I need to make estimated tax payments? What are the tax implications? Kind of bigger picture as it relates to my tax situation. I think ESPPs and incentive stock options, like there's just plenty of opportunities to get tripped up there and have a pretty big unexpected tax bill and an
Yep.
undesirable tax
Outcome.
outcome. So like you've
Yeah.
had lots of conversations with people about ESPP stock. Like where do you see people getting tripped up or kind of falling into a tax
Yeah.
trap because of a decision they made and there was unintended consequences from it?
100%. A lot of the bigger custodians that we see companies work with for like their ESPP, let's say, um, they have all the information in there you need to know what your tax liability is, but it's not always the most visible. It's not always, it's not, there's a line saying, hey, you're going to owe this exact dollar amount in taxes from this transaction. It might say how much is capital gain. For ESPP, there's a part that's ordinary income. It doesn't even label that a lot of the times. And so it's if you just go and click sell and you see this capital gain number, you might expect that, but the income could be hidden. And there's nothing that really tells you that until you get the unexpected tax bill. You put in your W-2, TurboTax gets the information from the employer, and then all of a sudden, dang, now I owe $2,000. Why? And that's already a year later. Now we have late payment penalty type deals and all sorts of other things going on. So that's probably the most common thing that we see is just unfamiliarity with needing to look for it and expecting it to be front and center, like shown to them.
Yeah, and I think the other piece is like um, not understanding the difference between a qualifying and a disqualifying position, and
Yeah.
what
Yep.
what triggers being a qualifying disposition,
Yep.
which is a more favorable tax outcome, um,
Sometimes.
but not necessarily
Sometimes.
the best outcome, and you
Yeah.
can burn yourself there too. So
Yep.
the example that comes to mind for me is, if you bought, my numbers aren't going to work out exactly here, but play along. So say that the company stock is $50 on your purchase date, and because of the discount that you have, you buy it for 45. And the stock price has since dropped to like $40. And you're like, okay, well, I am at a place now from additional RSUs that have vested or ESPP stock that I purchased that I now have more than I want to have from like a concentration risk perspective. So let's go in and sell, like, get as much stock out of there as I can for the least tax cost
Taxes.
possible.
Yep.
You might see ESPP stock and be like, well, I bought this for 45 and now it's at 35. Like, I can sell that, no problem. The problem is if that's a disqualifying disposition, you're going to be taxed on that on the actual discount that you received on the purchase date, which is the difference between $50 and
Yep.
$45 per share, even if it's worth 35 today. And so you'll have that taxable ordinary income hit, and now you'll have a short-term loss or potentially long-term, depending on how long you've held it,
Yep.
to offset that. But you may not be able to use that all because you can only use losses to offset other gains and up to $3,000 of ordinary income. And so it just, that's not a great position to land of like, well, I lost money on this and actually I still owe taxes on it at
Yeah.
ordinary income and I couldn't use all those losses to kind of offset that. And so that's definitely an area where I think you want to be extra thoughtful about when you're selling ESPP stock. Is this a qualifying disposition or not? What has happened to that price since the purchase date? What's the tax character of all these
Yep.
different layers? And even in a, this is just, it's ridiculous to me, but you know, in a disqualifying disposition, that ordinary income component is the actual discount you received on the purchase date. If it's a qualifying disposition,
Yep.
it's the offering date price less the 10-15% discount, whatever you got, and whether there's a look back or not. So like even the definition of that ordinary income is different.
Changes.
So
Yep.
it's really important to understand like all the moving pieces that are involved with equity comp in general. But I just think ESPP is kind of nuts, and also
Yeah.
is like one of
Yep.
the more common forms, right? Like
Yeah.
RSUs and
Yep.
ESPPs are what we see most, and it's
Yep.
like, oh, and this is like actually kind of one of the most complicated ones
Yep.
that a lot of people have.
Run into for sure.
Yeah.
Yeah, the ESPP, while the dollar amounts sometimes aren't as much as things like RSUs and options, they have a lot more impact in how you handle it. If you're somebody who's looking, I have accumulated 5 years of ESPP purchases, and you're wondering, what is the impact of not just one of these, but all of these together, even one or multiple, and selling them? The custodians have some great resources. We found some are obviously wrong sometimes. Some don't show all the information you need. So what we did is we went out and built and took our kind of hive mind here at Plancorp. An ESPP calculator is what we call it. You can find it on our website. It shows the performance impact on the shares that you've had. So, hey, this was your employer discount. This was a discount that you got from a look back provision. What's your total gain or loss? But then it also breaks it out into the taxable components. So we're not showing how much tax you're going to owe, but how much of it is going to be ordinary income, how much of it is going to be short-term gain or loss, how much is going to be long-term gain or loss. It's a really great tool to use, one, to test your knowledge a little bit, also just to see, hey, this is going to be a much more sizable impact. I sell this, I'm going to owe $100, or not owe $100, but I have $100 of taxes. I'm going to sell this and it's going to be $10,000 of taxes. Those are very different situations, and one you might need a partner for, one you might be able to handle yourself. So use the ESPP calculator to kind of bridge that gap into finding out more about ESPP and how it applies to you. And if it's too much, there's also a handy little meet Derek Jess, meet a member of our team that can walk you through it and decide if finding a partner like Plancorp's right for you.